Welcome everybody to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is my partner Cameron Mealy. And today, as we usually do, we're going to go through, current economic numbers, the numbers in our portfolios, kind of what worked last month, what's been working year to date, and our thoughts moving forward over the next month or so. Cam, why don't you start us off with the economic update?
Will do. Thank you, Kelly. Good afternoon, everybody. Hope everybody's well. Kelly, as we've seen, we've certainly come out of this pandemic, and the economy is roaring. All the numbers that have come out the last month have been very solid. Let's start with the big number, GDP. So last month, we talked about an initial GDP measure, or the advanced estimate, of 6.1%. The Bureau of Economic Analysis has since come out and revised that to a 6.4% annualized increase. We're typically a 2% GDP economy. So again, 6%, very strong. If we look forward, the number we always quote, the Atlanta Fed's GDP Now model. Their GDP Now model for the second quarter is projected to come in at an annualized rate of 10.3%. So 6.4% in the first quarter, 10.3% in the second quarter. Very impressive numbers. What's driving that? People are getting back to work. So according to the Bureau of Economic Statistics, total non-farm payrolls rose by 559,000 in May, and the unemployment rate declined by 3 percentage points to 5.8%. 5.8% is obviously, a couple of years ago we were looking at 3.5%, but 5.8% by historical measures is extremely strong. Where are the job gains at? Notable job gains occurred in leisure and hospitality, not surprising, in public and private education, and in healthcare and social assistance. Now, obviously, all this strong economic information is going to cause us to continue to think about inflation. So let's look at the number one inflation gauge. This is from the Bureau of Economic Analysis again. The core personal consumption expenditure index increased by 3.1% in April, year on year, showing that inflationary pressures are building. The unemployment rate keeps ticking down. It's getting harder and harder to find workers. It's getting harder and harder to find core inputs, precious metals. We've talked about this. Inflation certainly seems to be here, especially thrown on top of that government spending. Now, the one counter to inflation is productivity. So according to the Bureau of Labor Statistics, non-farm business sector labor productivity increased 5.4% in the first quarter of 2021. Obviously, when productivity goes up, you can do more with less. That is kind of a natural hedge towards price increases. So, is productivity going to continue to be, keep us out of hyperinflation? I don't know. But the one thing we have seen is robotics, automation, cloud computing, autonomous vehicles. Robots are able to do more, and American workers, sometimes become an endangered species in some industries.
Well, it's an interesting dynamic because, especially if you talk about a small business owner and business owners in general, corporations, you try to figure out how to do more with less. Mm-hmm. And because of the labor shortages, you still get the same you still get the same revenue with fewer workers. It's a lot of traveling I've been doing. You notice it around the country. I've been in various places, especially down south, where things are open, but staffing's not there. Yep. But people are still going to go to restaurants. There's a lot of pent-up demand where, okay, I have to wait an extra half hour, 20 minutes. You're still going to wait. How much will customers put up with that?
After sitting inside for 12 months.
It makes the productivity numbers look better. Even in the airports, you can tell, there's a lot of lack of staffing in the airports, in the airlines. So once again, people are still flying, but how much tolerance will there be for it? Will productivity slip a little bit? Obviously, as more people get hired, you'll probably see productivity drop to some extent. We're in such a weird dynamic because this was not a normal recession. It was really kind of a induced coma.
Yeah, it was slam on the brakes.
Now we're coming out, and all the numbers are really skewed. The big thing, and I wrote it in the executive summary notes. Really the biggest elephant in the room is the whole inflation dynamic, that we are actually finally seeing real inflation. We haven't seen it for the last 10 years. It is here. We're seeing price increases, and how long does it stay with us? Is this, I think we talked about this last time, is it a one-time general rise in prices, then we cool down to our usual 1% to 2% inflation, or is this something that's going to have some legs to it? It's hard to figure out what's going to happen there. And U.S. is opening up. Like I said, I drove through half the country last week, and business activity is robust, traffic is robust, a lot of truck traffic, things are definitely hopping, and that's just in the U.S. Europe's not fully open. They'll start to open up. That will put more inflationary pressures on materials, on goods, on services. So this could last a while, and it really translates to, that's, I think, the big elephant in the room. And then, okay, what's the Fed going to do about it?
Right.
Which is, looks like they may start tapering their bond purchases, which back in 2016, that definitely sent some ripples through the market.
Janet Yellen has already said that higher interest rates could be good for the U.S. economy.
Well, it's going to be good for savers,
Yes,
and we can finally maybe find some CDs. But then again, as long as rates catch up to inflation. But on the other side of it, I think the Fed's still going to be very slow to make any drastic changes, very sensitive to what's going on in the markets, because what we're seeing now, does it really hold through? Is this just kind of getting back to normal? Then we kind of get back on a path of, which was, in my mind, prior to COVID, leading us to an eventual recession in 21, 22, 23, which, COVID probably just pushed that out. So, once again, the Fed's probably going to be fairly accommodative towards that.
I mean, are we going to see inflation in the future? Or to your point, are we just going to see this one time that gets us back to, because we haven't had inflation in 10 years.
Right.
So, I mean, are we just going to get back to a normalized inflation rate that should have been 2% for the last 10 years? I will tell you what is not going to help deflation is President Biden's new budget that he unveiled.
Right.
So, I mean, everybody's seen it in the news, but the president a couple of weeks ago came out with a $6 trillion budget. The proposed budget would ramp up spending on infrastructure, education, and combating climate change. This I love, arguing it makes good fiscal sense to invest now when the cost of borrowing is cheap and reduce deficits later. So the president's $6 trillion budget is projected to add $1.84 trillion to deficit. One of the most controversial aspects of it is his asking for a retroactive increase in capital gains back to April. I think at the end of the day, this is a very, like many budgets, this is a very grand budget. It's something you can talk about. It's media points. But this budget has not been well received.
No, this is not written in stone, and there's a lot of changes to be coming down the pipe. What it's really going to look like, who knows? What we do know is what's been spent or committed so far. It's a big number, and historically, the reality is the only way that's paid for, it's not through taxes, it's through inflation. Yep. And that becomes even more
inflationary pressure.
Well, it causes even a greater wealth inequality. Yep. That's the reality. So we're going to continue down that path. And once again, how long does this last? Who knows? But the other side of it could potentially be deflationary, which is not good. Bottom line, it comes down to, in this type of environment, we don't know when it's going to happen. Could this drag on a couple of years? Who knows? It very well could, because we're in uncharted territory. So we kind of need to stay invested, but where we're invested is going to matter. And we want to stay invested in things that are making real money now, or in the very short term, growing those cash flows. Mm-hmm. Hard assets are important. Commodities, real estate, having exposure there is important, and minimizing your exposure to higher interest rates is the path we're going to stick with for the foreseeable future.
Good and profitable companies continue to be good and profitable companies, even in inflationary times.
Exactly. So that's really, kind of the theme that we're going to stick with. We're not making any drastic changes. And the other thing is, we're not going to get too cute with anything. No. Leverage will be the death nail, and ultimately the companies that are going to have the most trouble when we do hit the bump in the road are going to be the companies with the excess leverage, excess debt out there. That's really going to be the separator getting through everything. But relating back to what happened in the last month or so, in May, Dow Jones up 2.07%. The S&P lagged fairly significantly. The S&P was only up 0.5%. The NASDAQ was actually down 1.62%. Russell 2000, which is small company stocks, down 1.5%. International markets definitely picked up the pace. They're up 2.12 on the developed side. On the emerging market side, 2.89% for the month of May. So a good May in general, except for, once again, your more speculative or, your tech type stocks, definitely lagged. Year to date, that takes the Dow to 13.76%. The S&P lagging a little bit, 12.62% year to date. NASDAQ, this is where the divergences come in, only up 6.52. Small cap still up 15.3, but the reality is they've been giving up a little bit of ground. They were real strong early in the year. They've pulled back. Emerging markets, even though we had a great month last month, still up only 7.36%, and the developed world international up 10.39. So that's kind of the markets in general. Growth with income, good month for our growth with income portfolio, up to 2.25% year to date, up 6.42. The big winners in May, CVS up 13%, NVIDIA up 8.25. Nucor, new adding, we just threw that in. I don't even know if we were in there before May, up 7.09%. Gold kind of rebounded. Gold was lagging in previous months, kind of went through a little, a little pullback, up 7.68% for the month. Big loser last month, big losers, Disney down 4%, Verizon down 2.25%. Year to date, Lennar, our home builder, up 30.59%, CVS up 28%, NVIDIA up 25%. Year to date, Apple's still down 5.79%, so Apple's lagged. Nike down 3.15. A lot of good ratings coming in on Nike, and then Verizon down 1.76. In the dividend yield portfolio, good month there, up 2.51%. Year to date, up 16%. I mean, this once again, for a more defensive portfolio, definitely doing well. Outperforming the indexes at 16%. Big winners, Lyondell Basel up 8%, Prudential 7.75, CAT 5.69, UPS 5.78. So not huge gains for the month, but the reality is, these companies have just been kind of chugging along. Losers, Verizon again, AT&T down 5.9. We actually got out of AT&T. And then Southern Co down 4.45. Year to date, Blackstone still up 46%, Pru up 41%. So a little theme with financials there. Caterpillar up 33.75, and then Lyondell Basel, which got crushed last year, up 25%. On the loser side, year to date, Merck's only down 5.6 and Verizon down 1.7. So a lot of winners in that dividend yield portfolio. Price potential up 2.29% for the month. Year to date, up 11.25, lagging a little bit. Big winners there. Centene up 19% for the month. Perkin-Elmer up 12% for the month. Morgan Stanley, another new holding, up 9.25. So we caught a nice little pop in Morgan Stanley there. Big losers, FleetCor Technology down 6%. Whole down 3.8. Stryker down 2.8. Year to date, our big winners there. Aflac up 29%. Allstate up 25%. Once again, financials rolling. CBOE, the Chicago Board of Options, up 20%. VMware tech stock up 13%. Big losers, Becton Dickinson, which they're basically like a pharmaceutical wholesaler or fulfillment company, down 5.47. Other than that, no other positions that we're holding are negative year to date. So price potential, there's been a lot of rotation in there. I like where we're at. I think we're seeing some good momentum happening in price potential. Our small cap portfolio, obviously small caps took it on the chin a little bit, down 1.26%. Year to date, still up 15. Big winners, Acushnet, the golf club company, up 26%. Progeny, a tech company, up 13%. Radiant Logistics up 15%. LGI Homes, another home builder, up 9% for the month. Big losers, SI Bone, another biotech, down 15%. Johnson Outdoor down 13.8%. I guess people don't want to stay in hotels or want to stay in hotels again versus camping. Mesa Air down 13.68%, and then Installed Building Products down 11.92. Year-to-date big winners, once again, LGI Homes up 71%. Lennar was great, LGI even better. A little more aggressive holding, that's why we didn't put it into growth with income. That sticks with the small cap stocks. Progeny, even though it was down last month, still up 51% for the year. Proficient, it's up 50% for the year. Virtus up over 30% for the year. And once again, Acushnet up 31%. So some nice winners there. Big year-to-date losers, Blink down 22%. Once again, Johnson Outdoors, even though they got killed in May, they're only down 3.2. Power Technologies down 6.81. So overall, small cap struggled, but still, relative to their benchmark, did all right. Our other portfolios, I'm pretty happy with. I think we're in the right spots, and this month, I think it's gonna be more of the same, kind of the same kind of churning around in the markets. It's going to be the surprises that throw the ripples through the market, and the big things. What's inflation look like, and how do these budget debates go? And
we say that. I mean, we say
stuff.
this all the time. We're quality focused. Quality, quality, quality. At the end of the day, quality rules. It might not always be sexy, and you sometimes will lag the indices. The market has been up since 2009, and so everybody looks like a genius as a stock picker. But with a focus on quality, when we do some decent dislocations, we expect our portfolios to stand up well, and that's what we're really going for. Long-term, quality is always going to be a winner.
Yeah, we've been holding up well in the pullbacks.
Yeah,
that's the key. So that's kind of where we're at. I did make a note in the monthly summary. The big way to kind of hedge against the unforeseen pullbacks. And one thing I want to emphasize with everybody is, if you are planning distributions in the short term that we're not aware of already, please, give us a heads up. We just want to make sure we have plenty of liquidity in people's accounts, so we're not caught having to sell when things are down. And that's gonna be the best way to hedge against this. Like I said, we don't want to get too fancy in the derivatives world, just because leverage has gotten so high in those areas that a lot of that stuff is not going to work as planned if we do see a major dislocation. Other than that, like I said, I think the next couple of months, more of the same. Just kind of hold tight and keep chugging along.
And feel free to call us with any questions. Thank you.
Thank you, and have a great week.